Warren Buffett's investment advice has stood the test of time, boasting about 80 years of stock market expertise. Having learned from other great investors, there are certain essential pieces of knowledge to consider. Investors can avoid two typical mistakes and maximize their earnings by following some of Buffett's suggestions. Keep watching until the end to find out what Buffett suggests for most investors trying to build a well-diversified portfolio. Welcome to Cashflow Canvas, where we teach lessons about investment and money-saving techniques. If you want to make your financial future better, make sure to like this video and subscribe to our channel for the latest updates. Invest in your knowledge. Investing in something you understand is one of the simplest ways to avoid making a mistake. It's better to avoid any investment that is too hard for the typical person to understand or that you are unfamiliar with. This may apply to numerous aspects of the stock market, but it does not end there. Small enterprises, real estate, gold, cryptocurrencies, and a plethora of other channels are examples of investments. A startup expert may make a fortune, but that does not guarantee it will be beneficial for everyone. When it comes to equities, only invest in companies whose business model and revenue generation you fully comprehend. Quality should never be compromised. While sticking to what you know is pretty simple, judging the quality of an investment is more difficult. It's critical to understand whether you're buying a high-quality asset because a cheap stock or sector isn't always a solid investment. High dividend yields or extremely low prices in comparison to their peer stocks sometimes tempt investors. This could signify a discounted stock, but high-quality assets are rarely for sale. Paying a greater price for a high-quality stock is preferable to paying a cheap price for a low-quality stock. Plan on holding a stock indefinitely. If you buy a high-quality asset, you should intend to keep it indefinitely. In the words of Warren Buffett, if you're not thinking about owning a stock for 10 years, don't even think about holding it for 10 minutes. This is because you want to be assured that the investment will be successful. Purchasing an investment that you are unsure about or have reservations about greatly raises your risks. Furthermore, the frequent buying and selling of investments reduce returns, mostly due to taxes. Even high-quality businesses encounter obstacles that could derail their progress, such as onerous regulation, increased competition, or the loss of key management staff. However, the higher the quality of the firm, the less probable such events will be harmful. Diversification can be dangerous. Diversification advice comes from everywhere, but Buffett believes in diversifying across a small number of companies. The more equities you own, the more difficult it is to stay on top of their fundamentals. Although owning more than one or two equities is recommended, there comes a point at which over-diversification can prevent you from investing in what you know. Most news is just noise. Constantly changing news headlines might make investors nervous. However, much of this news, whether good or bad, may be insignificant. This also applies to individual stocks on a smaller basis. Is it really that important if one of your stocks has slightly disappointing earnings? It could indicate poor future performance, but in such cases, shareholders frequently overreact. You must assess whether it is long-term relevant. Will it have a substantial impact on the stock in 3, 5, or 10 years? The majority of news headlines and television stories are meant to elicit emotions and increase ratings. In actuality, many of these stories will be forgotten in time. It is prudent to keep up with current events but not to place too much emphasis on them while making investment selections. Investing isn't difficult. One of the most common myths regarding stock market trading is that only expert investors can successfully select equities. This is partly true because many private investors buy equities without sufficient expertise. Anyone who is willing to work hard and undertake thorough research has a fair chance of success. According to Buffett, investing is not a game in which the person with the highest IQ wins. Investors should set realistic goals and recognize that there are no shortcuts in investing. Anything that appears to be a fantastic chance should be considered a red flag. There is no single magic strategy for outperforming the market. Price and value are not the same thing. Although stock prices are easily accessible, determining a company's fundamentals requires more effort. Viewing stock prices without further information is pointless. Emotions cause the stock market to fluctuate, resulting in overpriced or underpriced equities. During a recession, the market may appear to be on sale due to emotional selling. In contrast, during times of economic expansion, many assets become overvalued. It is critical to assess a company's worth in order to determine whether the stock price is appropriate. Just as you wouldn't buy a house based just on its price, evaluating equities necessitates going beyond its pricing. The best moves are frequently banal. Don't invest in the stock market with the intention of becoming wealthy immediately. It is intended to provide modest profits over time. Because emotions can impair judgment, investing should not be extremely thrilling. Investors should seek out quality companies or funds that rise consistently over time, allowing for compound growth. While speculative investments may appear appealing, they should be considered gambling. When you've accumulated a sizable fortune, avoid putting it all at risk on obvious once-in-a-lifetime possibilities. Index funds are appropriate for the majority of investors. Many investors underperform the market owing to emotional decisions or lack of information. Purchasing an S&P 500 index fund, which Buffett advises for most investors, is a great alternative. This gives diverse exposure without the need for in-depth understanding of particular stocks. Stick to your strengths, invest with a long-term attitude, and avoid over-emotion. Implement these helpful tips from Buffett, an investor with unrivaled knowledge. His counsel can help you make lucrative judgments whether you buy individual stocks, funds, or other sorts of investments. As we conclude, I'd like to thank you for watching. I hope you found value in this video and learned something new, and I look forward to seeing you in our future videos. I would deeply value it if you could like this video and subscribe to our channel. Your support will help us to create more valuable content, and we can work together to secure your financial future. What are the key takeaways from this video that you can share in the comment section?